time for a new strategy. A strategy that I've been looking at and thinking about for quite a while, and I'm going to share it with you now live on the show, and I'd like your thoughts and comments below whether this is a winning strategy, a new idea. As you know, I'm fully 100% in the S&P 500. One, because the integrity of the show, so you know I'm not pumping and dumping any stock. It's the most recognizable, most reliable, most stable asset of the best companies in the world. It's a great asset to own, but it's also, of course, for the integrity of the show. But I was thinking of applying a new strategy to this, the way I trade and invest, and I'd like your thoughts and comments. I'm going to go through real trades, real positions with you right now, and tell me what you think of this. So, this is my overall portfolio. As you can see, we're up today. I've used all my cash, so I'm always investing 100%. I don't believe in money sitting on the sidelines. I don't believe cash is king. I can always access money because I get paid every month on YouTube. I use my Robinhood credit card to buy stuff. I earn cash back 3% on everything. And every month I pay off my card and invest all my money. I don't need any money in the bank. In fact, I have no money in the bank. I have $10 in the Bank of America in the US, and I have £10 in my Lloyd's account in England. That's it. That is all the money I have in the world in the bank. I have no money in cash at home at all, but I have no debts, no car loan, no mortgage. Everything is paid, and I pay and I manage all my bills every month from my income on YouTube. And once I paid all the bills, which is basically paying back the credit card, because I pay every bill on my credit card, so every bill gets 3%. I put all my cash in. So if I ever want to get any cash out in extra to my income that I have every month, I can always sell a share from the bottom of the pile, or use tax lots, which is partly what I'm going to show you now. So that's my strategy for cash. I'm all in. And then I use margin as well, because if we've got stocks massively oversold, macro conditions, we've got big selling because of tariffs, fears, whatever reason, not because of the actual quality of the business or the ETF in my case, but macro conditions, uncertainty. Markets sell off. It's not because the companies are bad or the economy's bad. It's just people sell off because they don't want to be in the market for uncertainty. They'll just put their money somewhere else. So in those situations, I use margin. I never use margin to buy on the way up or just because I feel like it. I use margin to amplify when things go dramatically down. Okay, and then I spend the next few months or year, whatever it is, paying back the margin as we start going up again. And I only ever buy on the way down. So now you understand my cash and my margin position. But I'm going to put this to you. With my cash, I buy and I never sell. Unless I really had to find some extra money, I can sell. But I don't plan on selling, so I don't pay any tax. I don't have any capital gains. I just hold, let it compound over years. In the future, I'll either sell it all or borrow against it, whatever. But that's a strategy for the future. So with my cash, it doesn't matter what I buy on the S&P because ultimately the S&P is always going to go up. Why? Even if stocks go sideways, it's one thing you can guarantee on going up. One, printing money, and two, inflation. So the value of your stocks will always go up over time. 100% has done since 1850 or whatever it was when the S&P was firstly formed in the United States. So you've got to remember, it's had different shapes and sizes. We use VU, but the S&P's been around since the mid-1850s, whatever it's been. So it's always going to go up. So using all your cash to buy the S&P, as long as you've got income coming in, is always fine. You can always sell and take some profit along the journey if you need to, if you don't have any income or whatever your circumstances change. However, margin's different. Margin is going to cost you money, right? So you're going to pay an interest. It's not free. It's not like your cash. Your cash doesn't cost you any money. In fact, cash saves money because if you had cash sitting down doing nothing, it would lose inflation every year. So your money would go down and down over time. So you don't lose any money by buying the S&P with your cash. But margin Yes, you do, because it costs you 5.25% annually at the moment, for me anyway. A lot of brokerages are higher. You might pay more if you're on a lower level on Robinhood, but I pay 5.25 on the money I borrowed, which is still fine because I earn at least 10. This year I make 23% because I bought the dips. So we had a 13% down run plus the 10% annually that you're going to make. So 23% at a cost of 5.25. It's a no-brainer. However, I'm going to give you this analogy, and here's a little extra twist to my strategy, and let me see if you agree with this. If you went into a supermarket or a clothes shop, and let's say you bought a pair of Levi jeans, and they were $50, and you bought them for $50, thinking they're on sale. Bit like me with the macro dips. Everything went down and Levi jeans are on sale. Used to be $100, they're now $50. So you buy them with your margin. You borrow them on your credit card because it's a really good price and you'll get paid at the end of the month when the price will go up. So you want to buy them now using borrowed money. That's what margin is, right? So you get your credit card out and you buy a pair of Levi jeans, 50% discount. Lovely. But you're using margin. You're not using cash, you're using margin. So there's a cost to that. And you have to manage your risk. You can't have infinite amount of margin. Otherwise, I could have $1 million of margin and never pay it off. That's okay, perhaps if you want to hand it on to somebody. But if you're thinking of just cashing out all your money and living a great retirement, you don't want to die with margin, right? Maybe you do, maybe you don't. I certainly don't. So at some point, you've got to pay it off and you're going to only pay so much off. So you've got to manage your risk all the time. So you buy your pair of jeans for $50, they're on sale, using a credit card, using margin. A few days later, it goes down even more, a bit like the stock market. And now jeans are $25. And you go, ooh, hello, $25 now for that pair of jeans. In my case, the S&P. I buy some more using my credit card, using my margin to use the analogy. So now I've got even more margin. Margin is getting higher and higher and higher. And the idea is I want to keep my margin manageable and I want to keep bringing it down. But it's okay to go up when it starts to go down. And then when it go up, you start paying it down again. All right. It's all a transient thing. It's always flowing and moving. All right. So we understand that. Okay. Everyone gets that. We're all investors here. So now you've got your pair of jeans for $25. Then the market starts to go up, like it has the last couple of days. So you're making money. That's the very reason why you bought all these dips. Everything is making money. But you're looking for a way to reduce your margin. So you want to sell something, but you don't want to pay any tax. You don't want to have a capital gain, and you also don't need to lose. You don't want to post a tax loss either. Maybe you do, maybe you don't. But in my case, I don't need a loss because I've not posted any gains since I've been doing the S&P. So I've got no gains, so I don't need to post a loss either. But you'd like to swap. There's the key word, swap the pair of jeans that you bought for $50 for the pair you bought at 25. Makes sense, right? The ones at 25, a lot better than the ones at 50. Now, this only applies to your brokerage account. You can't do this in your Roth IRA. But in your brokerage account, you have a thing called tax lots. Now, of course, you bought them because you want to see them go up and you don't want to see them go down. But reality is you got a pair of jeans, pair of stocks, whatever you like, at $25. When it was 50, you got a few more that were less. And I'm going to show you on the screen right now. And you swap them. Like going back to the shop, going, can I bring this pair of jeans back? And they go, well, you paid $50 for those jeans. Yes, sir. Thank you very much. Can I have my $50 back? Yeah, because it's gone back to $50. Where you paid for it. It's not a profit. It's not a loss. It's just gone back to where you paid for it. Yeah. We can return those because I want to keep the ones that I paid $25 for. Now, this isn't a perfect analogy because with a pair of jeans, you only want one pair of jeans. And if you can get them for less, why not? Keep the ones you paid $25 for, the ones you paid $50 for, take those back. People do that all the time. At Christmas, they get jeans or presents, go back in the January sale, take them back, get twice as much. All right? People do that all the time. So you could do that. But you could do that now with stocks. Now think about this, and I'm going to share with you what I mean. So scroll down here Go onto my VOO and you can see I'm 100% in the S&P. There's my VOO, 282,000. Collectively now I've got about $317,000 invested altogether with my Roth IRA and this here, 317. I started with $5,000. So I've done very well. Hurrah for me. There you go. But if I go into trade, I need to probably clear the screen a little bit so you can see a bit more. All right. Okay, there we go. Let me take away the tickers. You can see at the bottom it says trade. So I click trade in my brokerage account. Okay. And I sell. And I click sell. All right. And I go up the top and I click shares. And I click tax lots. All right. Now I look at all my individual lots. These are all my trades that I have made that I own. These are all the shares that I own in the S&P. The ones I've sold, they're gone. These are ones that I own. This is my real-time, real-live action of my positions. You can see there's the date. There's how much money I've made on that lot, on that transaction, and how many shares I've got. You can see I had 10 on this one. If I click 10, at the bottom of the screen, right at the bottom of the screen, you'll see it says $105 gain. So that's what I'll be taxed on, short-term gain. And it says I've got a credit of $5,295 if I sell that. Hurrah! Great, there you go. I bought at 519 on March the 21st, 4 days ago. I can now sell to all 10, or I can adjust the number. I can do 1 to 10, whatever. Click that, sell that. I'll make $105 profit, and that's what I'll get taxed on. And I've got $5,295 back in my portfolio against my margin. Great, my margin gets reduced. I'm now not paying 5.25% on $5,294. Hooray! All right, and it would actually give me about $10,000 of buying power, because when you bring money back in, it'll often double your position. All right, here's a little thought for you. So let's scroll down, and let's say I've gone back to the shop, and I bought, in fact, the easy way of showing you is this. Scroll to the very bottom of the list. Now, it's no surprise to anyone to see what I bought back in 23 has the most gains, obviously. All right. These are all the positions going through in time, and you sell from the bottom of the pile. So what's been sold before is gone. This is what I've got left. I've got a share here I bought on October the 1st, 23, and you can see it's made me $212, and I've only got 0.1 of it. It just shows you what I've got there. That's the biggest gain, right? I bought that at $416. All right. Anyway, scroll all the way down, and you can see all these positions are all in green. They're all making money. Sell all of these, all profit, wonderful stuff, lovely. Scroll back. This is great. Look, all this in profit. Hurrah, I'm the greatest trader in the world. There you go. Scroll back. Now things started to go down, and I started to buy on the way down. Here it is. February the 13th, I started to buy. I bought at 554. I started to buy more on the way down. But it kept going down. So I bought at 550, but 530, 533, bought 538, 533, 529, it's getting lower. So I bought some up, some down, all different positions. But you can see all these are out of the money. No money made on these yet. Okay, 448, 438. I thought this was the bottom, and then it kept going and going and going. We keep on scrolling down, and now I bought a much lower, and these have all made money. Hurrah! Greatest trader in the world. Fantastic. So what I'm saying is this. You go back to the store with the shares or the jeans you bought at $50 and say, I want my money back on these, please, because I'm quite happy with the ones I bought for $25. And they go, yep, you can do that. Well, that's what you can do with tax lots. So I can go back and I can say, all right, all of these shares at the bottom, it kept on going lower. This was the actual bottom. These are all up. But these ones here haven't made me any money. Now, these were higher. Obviously, that's why they're red. Now I can look on those and I can find, you can see there March the 5th, I bought 2 shares at 530. I'll highlight it. There you go. That is a tax loss of $1.66. Great. If I sell those, I will lose $1.66. Why would I want to do that? What's the point of doing that? You're going to lose $1.66. No real point. But it's not very much, is it? $1.66. As it starts to go up now, you can see it's now $1.32. It's about to hit zero. So I won't lose any money and I won't pay any tax either. It'll be a wash. Now, what I could do is just choose one that's made $30 over there and just make a small profit if I wanted to. But let's just say I choose to sell those. It's on the way up now. Let's get it to zero. So I don't lose any money or make a dollar, lose a dollar. It doesn't really matter, right? The point is, if you look at the bottom, I will have an estimated credit of $1,060. I will sell those 2 shares in that lot. Right, so I put $1,000 back into my margin, which I'm not paying 5.25%. So what I've done basically is I've managed to swap, because I've got more shares than I really want right now. I've got too many pairs of jeans. I bought too many tubes of toothpaste. I don't need this much. I want to reduce my margin because I think even though we've gained and we've rallied and we bought the bottom, we're still not out of the woods. There's going to be a further drop. There might not be. It might carry on going up. It doesn't matter. I want to manage my margin because my margin costs money. Like I said at the beginning of the video, my cash investments don't cost me any money. In fact, they make me money because the cash would have lost money with inflation. So it's always worth buying, but it doesn't cost me anything to buy, right? It's just my cash. But my margin costs money. And I want to reduce it over time. And we have bought the bottom, but we can still bounce around like we did this morning. Like we did this morning, you noticed this morning, we popped up and we went back down again. There's a little bit of volatility, and there's going to be volatility all the way through until April the 2nd. And who knows? There might be volatility after that once again. Who knows? But the point is, this allows you with tax lots the opportunity to go back to the shop and say, I don't want these jeans I paid $50 for. I want the jeans I paid $25 for. Now, if you can see, as I'm waiting, my loss now, if you look at the bottom, is just $1.26. It was a few seconds ago, it was 96 cents. It's virtually a wash now. So I could click done and sell and basically wait for a further reduction to be able to buy more down at these levels. Now, it may not go down and it may go up. Nobody knows. But we know where the bottom was and we know there's uncertainty. It just allowed me to buy on the way down with my borrowed money, knowing I always had the intention of not wanting to borrow that amount. If for some reason this is more than I want to borrow, this is more than my managed risk, I would want to reduce this. So it allows me the opportunity to go, do you know what? I want to be fully invested. I'm fully bullish. I've got all my cash, all invested. I've bought everything. I'm not selling. However, I would like to swap the ones I paid $50 for the ones I paid $25. That's essentially what you're doing. And you're going back, you're getting rid of those for a wash, no loss, no gain, getting your money back, reducing your margin, saving 5.25. And then if it drops further, because we now know it can, because it did, you can buy a little bit lower. So you could improve your position. Overall, you'd improve your position. You'd use that $1,000 credit to buy even lower. So what do you think about that for a new strategy? Now, I'm just going to clear that out because I'm not actually going to do it today at this precise moment. I'm not going to do it. I'm going to come back out of there and I'm going to come back to my main position. And there we are. But what do you think of that as a strategy? As a way to identify, I want to buy on the way down, but I don't know where the bottom is. Nobody does. So when we get to the bottom, I'm buying all the way down. So my margin is getting a little bit hot, a little bit too much, but I'm buying on the way down. As it starts to go up, the ones that start coming into the wash zone, where there's no gain, no loss, just wash, sell that, reduce the margin, those particular shares, no tax event for you, and you've got the shares that you wanted at the lower prices. So you've guaranteed a little insurance policy on the way down. Where was the bottom? Because that could have been the bottom. As it turned out, it was lower. But because we've got volatility and we could go lower again, there is a threat we could go 10% even lower. You could use that money to buy lower without ever losing any money, without ever posting any tax gains, just simply swapping out your $50 pair of jeans for a $25 pair of jeans. What do you think of this strategy? I'd like your thoughts on this. It's something I've been thinking about for a while. I've been studying every day and watching the movement of the market, thinking this could be an addition to what I already do. I already know that I just want to buy the S&P. I already know I use margin to buy macro dips, but margin can get really, really big really, really quickly, especially if you're not selling. I never sell, and I'm only paying down with what I earn. So, my income isn't going up that much to cover the ever-increasing margin. So it's just an idea. What do you think? Leave me your thoughts and comments below. I'm making this live. I'll go and see what everyone says in the chat right now. But leave me your thoughts. Click above there, my head for all the links down below in the description. And I'll post some other videos in the comments you might find useful. Over here and over here, I'll put some videos I think you would enjoy most. There you go. Leave me your thoughts below in the comments. Until next time, as always, take care of yourselves and each other.